This is December 2021 Regions Financial Stock Valuation. I've been really looking forward to getting this done. We are currently down roughly uh, 16%, which it's a fairly large drop. A lot of that has with options that we were able to cash out at around $26. Um, However, cash from the sales, which is what shows on our broker statements, which is strange to say the least, because when you look at the broker statements, it shows, that we purchased the shares for like $22, and there's times that we have this great profit on the position, and I have to constantly remind myself that, oh no, we don't have a profit, we're actually at a loss. And so that's the real importance of accounting and making sure that everything is calculated properly and maintained over time. So anyway, anytime that we have a position that is down more than 10%, it warrants us to take a look at it to determine whether or not we are to purchase more shares or potentially sell out of the position, even if it's at a loss. I can say that over the last 6 years, we've had only once. It was with General Electric. And I did a evaluation on General Electric, so sold out. Spoiler alert, Regions Financial looks awesome. I did a valuation on Regions Financial a few months ago, and of course I'll put that up on the screen. And this one looks a lot different. So let's talk a little bit about, again, how I do this, just so there's no misunderstandings. I do not include goodwill or intangible assets on the balance sheet of my analysis, and that's the reason why my analysis is going to look different than what you'll find on Yahoo or Google or whatever, right? But I make sure that I hold that across the board. So problems with the comparison. The reason I do that is because it's goodwill eligible a dollar amount, and my concern is always with the money, right? Don't tell me what you're worth. Show me your bank account, right? So anyway, the cash, you'll see from 2018, I always go 3, right? So nice number. Second time. Sometimes the second time is coincidence. Third time, I get that 16% between 18 and 19, and then by a whopping 300% between everything. We don't be all of that stuff. Regions have said many times in their earnings call that they expect roughly 85% of all loans to be. So they think about it on a stay on and trouble with the internet. I hope I'm able to navigate and get this video done. If it doesn't happen, I'll try it again tomorrow. But either 300%. It's not a bad thing. Financial has definitely purchasing nuclear, it's the ball capital. There was another that completed this year. I forget the name. Earnings summary, I'm sure. But anyway, Sabal Capital is the most significant one. They are in the loan business. So most of their stuff is multifamily loans, which is very popular right now. And decent company, all right? Decent company. So let's quickly go through these numbers. So again, cash is just cash on hand. Investments are their debt securities. So they, of course, purchase things like treasury bonds and they purchase that we discussed it a little bit. So commercial paper is receivables. So typically, a company issues credit to the company. Well, typically, the company doesn't keep that credit on their books because what they want is the cash, what it's worth. So if they vouch for $500, charging the customer $700, right? The company says $700. What they want, vouch. So what they do is they take that $700 debt instrument and they sell that on the open market, and it's called commercial paper. And then banks and investors and everyone else can for less than what it's worth. So if the customer owes, the couch company $700, someone may purchase that debt security for, let's just say, $600 or $500, sometimes maybe even $400, right? But typically it works out for both the couch company. So anyway, so that's one is corporate bonds. And corporate bonds is something that I definitely want to get into, especially and we will see at some point dividends. Right now, it's not that bad. More, and that will a year. I well, not sometimes. Every year, I am shocked at what sectors have just so few of those companies that we're able to invest in. I think right now there is maybe the basic material sector only has maybe like 4 companies out of the entire stock market that we can actually invest in because of the dividend. And so I imagine that one day it will come that there will be many companies, if any, um, that we'll be able to invest in, and then we will looking into that. The corporate bond works, and when you purchase, it says we will pay you, 4% or whatever for the year, but those corporate bonds go up and down, so you can buy a corporate bond for less than $10,000. And so you'll get the 5% on $10,000 back at the end of the term, whatever it is, 1 year, 2 years, 5 years, whatever. There's also the possibility of selling that bond, right? And sell the bond for 11,000. Interest on it, but on it. So that's an option. We're currently not chartered to do that, but it is something that we can definitely ask the partners to include. And so that's what the investments are for Regions Financial. And as you can see, uh, their cash on hand, right? So 29 versus 27 there. What their business really is, of course, as a bank, right, are loans. And so they're pushing out, 82,776 as far as loans go. That has not increased a whole lot, and that's something that's always been talked about in the earnings call. Something that analysts always point to, loan growth, right? Loan growth is literally saying, hey, do you need a loan, right? And people to give you their social security number, banking information, and sign up and sign on the dotted line for that loan and then pay the bank interest. And their loan growth has, in at least in the last 3 years, has not been, great, right? And I think, adding on, these smaller companies, I think is their way of trying to increase that loan growth. Sabal Capital, again, is a loan company, but they're not retaining Capital's employees. Meaning that, yes, they do have the loan, are going to be paying them interest on those loans, but they're not getting better salespeople, because at the end of the day, that's what loan growth is about. It's about sales. It's what this company does for the most part. And their growth in that area, what it will take to get there is just going to be better employees. People always about how loose you are in underwriting, right? And if person A is a greater, so we want to sell a loan to this person, right? And when you're a salesperson working for these banks and these loan companies, you get paid basically on commission. And we've talked about that in the last earnings call, where Regions Financial is paying more commissions, and so that hurts the bottom line. But as a salesperson, that's what you want. You want more commissions, which means more loans. And if you're a sales guy in the office, you have to send in that loan application. Just got this person signed. Underwriter decides, okay, this person is a great debtor. They're great. Fine. Check mark. Let's sell this loan, right? And then the sales guy is happy. He gets his commission check. Everyone's cool. Some companies have different policies and guidelines onto who is qualified for a loan, who's not qualified for a loan, right? And it's always a fine line as an investor, right? Because what I'm saying, you want to sell more loans. Is a bank that's selling loans hand over fist, not caring who their score, they don't care about, and then next thing you know, paying their loans and they go bankrupt, right? That is definitely a possibility. Happened before, will definitely happen again. So the question is the loan growth stunted because the policies are so strict, or is loan growth stunted because they just don't have the athletes? Um, Quoting a funny guy on Instagram. Mr. Go, shout him out. Mr. Go 30, I think it is. But yeah, maybe they just don't have the athletes. They just don't have employees to make it happen. Something that I'll definitely look into a little bit, because it sounds like this is going to be a long holding for us. All right, so I did not dive into this. Okay, this is just other assets. Some of these assets are things that's making money for them. Some things are not. Okay. I didn't dive into this. The number stays pretty steady, 75, 78, 83, and now 81. I do need to mention too. Um, so these numbers you see here are as of September. Okay, we do not have the final 2021 annual balance sheet as of yet. Okay, these numbers are 2020 and 2019 and 2018 annual final numbers. For 2021, these numbers can definitely move around, and I've used a little bit of to understand where the number go. All right, now I'll explain that here. But it's important that you understand that this is kind of what we're looking at. All right, and then, so for property, those banking centers, right? And as you see here, that number come down. It's something that they've talked quite a bit about in their earnings calls. They're closing banks. I always talk about the fact that my neighborhood bank has closed, and it hurt. And I'm sure anyone listening understands. When you have a bank to for years, that's close to home, you've built a relationship. You know the people working there, they know you. When you talk about the place that I mean, more intimate relationship is there. You know what I mean? And so for the bank to still be in business, which is great, but then to have the center close is a bit disheartening. Because now you have to go to a whole new building with all brand new people and try to have the same rapport, and it's tough, but that's what's happening through Rodri, and Regions Financial has done that as well. Um, and honestly, I don't think it's a bad thing from an investing standpoint. I want them to close branches because it means less money is paid on rent and lease and all this kind of stuff. So anyway, so the property are actual properties that they own. I'm pretty sure that they are leasing and renting out buildings and whatnot, but this is property they actually own. So this might even be, computers, vaults, whatever, right? All right. So interest is what they have come in. All right. And as you know, that number has moved around quite a bit, down 3% and then 77%. Um, um, I expect that number to grow. But, and that's with the companies that they've purchased over the years too, because every time they bring on a company also has interest that's being paid to them, so now the interest is being paid. All right, so deposits are liabilities, right? Because this is actually being deposited into the bank, and so that is a liability for the money that they owe. All right, and of course, that is the largest liability that they will have are those cash deposits. All right, debt, of course, is just loans outstanding that they owe money on. That number has come way down. I was really shocked by how much debt they've gotten rid of over the years. I mean, 29% decrease, 60%. So I expect that to continue. I don't know what the liabilities are going to be for these two new companies that they have coming in. So, maybe they got rid of a lot of this debt in the understanding that they will bring on these companies that will, and they will also assume their debt, and so they want to make sure that they keep that really low. Also keeps their rating up because for financial institutions, credit rating, and the number one thing you want for a good credit rating is you want to make sure you pay all your bills on time, but you don't want to have a lot of debt. You want to have way more cash than you have debt. And as long as that is the case, your credit score is going to be good. And for banks, that means your credit rating is going to be good. And no one wants to do business with a bank with a bad credit rating. That also means, as a bank with a great credit rating, it also means that you will be able to many times sell these loans, right, at a higher interest rate, right? Because everybody wants to do business with a bank that has, great credit, because your money is safe. You know what I mean? Um, all right, and then other loans, again, just other stuff that they owe for whatever reason, that this can be, accounts payable, whether employee compensation, whatever. All right, and then down at the bottom, what we have is a net. All right, and that just simply means what is the total assets minus total liabilities. And this is a stark contrast from what I saw in my last valuation with Hewlett Packard and Corning, which, of course, are companies involved with products, right, versus loans. And yeah, I mean, growing balance sheet. I mean, this is what you want to see. I mean, 13%, 16%. So I can't imagine that is going to change much. All right, on to shares. I was really shocked to see share growth because typically you see shares come down because of all the buybacks that a lot of these companies are doing. It reduces, but we hear that between 2019, they actually issued some shares. Whether or not that was issuance for employees or whether the market, whatever it was, they issued shares. Okay, but they did issue shares, brought some money in on the balance sheet. Currently, they're at 996 shares. Whether or not that number will move around, not sure about that. All right, let me quickly. Well, I'm going down here. All right, and so based on current balance sheet numbers, okay, based on current balance sheet numbers, we have a balance sheet price of $13.40. The current price right now is $21.87, okay, and so that gives us a price to book 1.63. All right, and so again, just to explain, the price to book is taking what the company actually owns minus what they owe, all right, and dividing that by the number of shares. And so this number represents how much of the stock price is actually backed by things that can be sold. And again, I want to reiterate that I am not including goodwill and intangible assets in this. So we're talking about only stuff that they own. The other thing that I didn't do on this particular evaluation is I did not look at different scenarios, like best case scenario, worst case scenario. And I didn't do that. All right. And the reason why I typically do it is because something like the loan portfolio, right? What happens if, for whatever reason, we find out tomorrow that half of their loans are bullshit? You know what I'm saying? I mean, I'm not saying it's gonna happen. The chances of it happening are slim, but it's possible, and then, the question then becomes, well, what is the company really worth when you start discounting some of these numbers? I didn't do that, all right? And a lot of the reason why is because price that I arrived at was fairly close to where we are now, especially when you talk about taking out the intangibles. Okay. All right. Okay. So that's that. Looking over the last couple years. Book price $12.78 in 2020, $11.02 2019, and then $9 in 2018. So again, what we see here is a steady increase, and it has to do with the fact that the shares have stayed about the same, right? They're not issuing a bunch of shares, but they've constantly grown their balance sheet, meaning that they're growing their assets and reducing their liabilities. And even though we did see that huge increase in 2020 with all this cash coming in from like I said, SBA, PPP, whatever, the ratios, right, as far as the book price, we don't see that huge jump. You know what I mean? It stayed pretty much steady, so we can trust that number. And so again, we see 16%. Pretty sure we're going to see an increase in 2021. Currently, like I said, it's 1340. Can that go to 14, 15 by the end of their annual year? I don't know. We'll see, but it is a possibility. Also, too, what I did was to get this price to book is I used the highest price for that year. So in 2020, the price was $17.30. That gave us a price to book of 1.35. In 2019, it was $17.54. That gave us a book price of 159. And then way back in 2018, the highest price was $20, and that gave us a book price of a price to book of 2.2. So let's talk a little bit about predictions. Again, like I said, I just using let me see. Actually, this one was okay. So yeah, yeah, let's go back to the top and talk about this just very quickly. 20 is what for end of year, right? And that is basically adding 8,000 from the 17 in 2020. Currently the cash. So what the number is probably going to be a little higher. It's possible that cash can come down for sure. Because they purchase two companies, and I'm not sure if this September cash includes the cash outlay for those. Well, at least the last company. I know it doesn't include the cash outlay for Sabal. So we can definitely see the cash come down. Matter of fact, I'm gonna pull it down even more. All right, so there we go. So this still puts us way over what it was in 2019, but brings it down for sure from the current number. All right, so investments like debt securities, we've seen a pretty steady increase the last 3 years. So I don't expect that to change much. 1%, 18%. Right now it's at 29, and so prediction is for 30. I don't think that's outlandish at all. Loan growth. Now this is an interesting one because remember they purchase these companies that have loans already on their balance sheet. So I do expect the balance sheet to increase the loans whether or not it will be 3%, I don't know, but I do expect the loans to increase. Then other assets, again, I think are going to also come from those. Again, we're talking about just random things that financial companies do and banks do and loan companies do that put money in their pocket, fees and stuff, just a bunch of random stuff, and then property. I do that to come down 1805. I expect it to increase or no, not at all. Again, statistics, I can't bring this thing down to be like way more confident, right? Um, I would have to multiply this thing times two, and I think that's going to bring us like way, way down, and that's just going to happen. We'll be looking at 17. Well, not far off from 1805. It's really not. Um, but you know, again, we do have the position of the thing that's going to hit the balance sheet. Who knows what their balance sheet properties are going to be? Interest. Um, again, that is owed to the company. Whether or not that will remain, I don't know. But again, going back over the last couple of years, we see a big increase from 2020 to 2019. And again, that is interest. Um, I'm sure from a lot of these loans, which again, 85%, it's not paid back basically. And so, what that does for the rest of the year, I don't think it's going to change much. Maybe in 2022, as everything is done with those loans, we may see that number come way down. But as of right now, I don't think it's going to move much. The I will increase. It's already to what 14 from 42. So I don't see why it wouldn't increase a bit more over the last couple months. All right. Deposits, they did talk about up. Um, and again, that just means people putting money in the bank and leaving it there. Um, I'm thinking that now that inflation has really came down, I'm sorry, not came down, but now that inflation is really here, right? I do think that those savings accounts will draw down. Whether or not we're going to have a large enough drawdown over the next couple months that's going to, and I'm saying next couple months. Remember, we're talking about October, November, December. So um, I don't know if savings accounts are going to draw down that much. Will they increase? Probably not. So let's move that number too, um, and let's bring that down. All right, and so that gives us. Make sure I did that right. Yeah, it gives us deposits of 10.7 versus 13.2. I mean, that's huge, though. That's huge. It's a large. That's a big. Um, that's hard to believe, right? I don't think they're going to be. I don't think they're coming down. So we're gonna leave that at a plus. And the acquisitions didn't bring any deposits, so I don't think this one, like I said before, they decreased their debt so much over the last 3 years. The statistics say that their debt should go to a negative, and we know that's just not gonna happen, right? It's not gonna happen. But I also can't increase the debt. Now, it's possible that they took on debt to purchase these companies, and if they took on debt to purchase these companies, then what we can do is we can increase the debt, right? And we can leave the cash where it's at. Sounds good to me. Again, we don't know. All right. And then other liabilities, it's increased over the last couple of years by about 20%. So, I mean, why not, right? So from 3,000 now, will it increase to 38? I doubt it, but it can. So let's just leave it there, right? Okay, so that still gives us a net of 14. Again, we're talking about a company that's grown actually pretty consistently when you talk about, a 3-year number. And so currently we're at 13. So can it get to 14? I mean, why not? Especially with those acquisitions, right? They're definitely going to come with liabilities, but I expect assets to outweigh the liabilities, hopefully. So, and then as far as share count goes, again, this is a company that has it's hard to say because we're only looking at 3 years. You know what I mean? They did have a decrease in shares, but then they had a slight uptick. 0.32% in share count. So will share count fall? I mean, currently it's at 996, which is just under the 1,002 that it was last year, and draw down further. Will it increase more? I doubt it. And if it does, it'll be only by a little bit. Again, we do have those acquisitions. I don't believe they used any equity to purchase those. I am really curious though. Let's just see. Let's just see what Yahoo says about the share count. Just curious. So I had 996, which was September 2021, and showing now I typed in share count. It's not giving me share count. All right, so I have to click to get share count. Not financials. Let's see, regions, financial, share count. There we go. All right, so that's macro trends. It's not bad. Let's see. All right. See, well, they got the same numbers I do. September 2021, 962. So, all right. Well, again, I don't, I don't expect shares to fall by that much, but they're definitely going to not increase. So we either keep the number the same or we decrease it. Right now, I have it at a decrease. All right, so that really doesn't move the book price around very much at all. 1489 is still what I have, which is a larger percentage of the share price. And so price to book is going to be a bit higher. Now, based on these predictive numbers, okay, based on these predictive numbers, that gives me a price of $24.89. With that being said, $24.89 is roughly the highest price witnessed in 2021. Okay, so that means that we've already touched that price, and the chances of us going above that are slim. Something would have to change to really improve that. And when I'm talking about an improve, I'm talking about the balance sheet will have to increase, right? We know that we're dealing with increasing balance sheet. We know that, but that balance is going to have to get above a 14 net. And right now, currently, it's only at 13, and we're predicting it to move to 14. I don't know. And again, we'll have to wait and see what happens. So, with that being said, based on the balance sheet, I'll say that Regis Financial is fairly priced, right? It's not undervalued. It's not overvalued. It's fairly priced. It's about where it's supposed to be. Okay. Currently the price is 21.87, but again, like I said, the highest price of 2021 was 24.89, and that's just kind of how this stuff works. Okay. All right. So moving on to the income statement. And this one is way more straightforward because I didn't exclude anything. Everything you see here is as reported from their quarterly and annual statements. Um, I do want to mention though, just kind of what this stuff is. So income is going to be basically interest income. So remember, they issue loans and people pay interest on those loans. The other thing here are fees, right? So they have debit card fees, they have bank statement fees, overdraft fees, all the fees you can think of. They have them in here. Now, what's important about income is over the last 3 years, it's been pretty steady. When you talk about a 6% increase versus a 1%, uh, basically means that it hasn't moved around much at all. Right now it's at 49. Will that improve to 68? That's a hard pill to swallow. Um, Especially when you're talking about the fact that they're bringing on these acquisitions and what sort of income these acquisitions are going to bring in. We don't know. We don't know. I did look around to try to find some financial statements, to get an idea of what we have to look forward to. I'm able to find anything. So, what I'm going to do is I'm actually going to bring this down, right? And so we're talking about now losing losing money, and that brings us to 64.64, which is still way above the current 49.34. Um, I can say that based on the quarterlies that I looked at, and let's go now. We can see what those look like. Kind of show you um, how I kind of came up with this. So this is why was I looking at this? I had this pulled up for some reason. See, okay, yeah, so income for 3 years. Okay, all right, yeah. That's pulled up. Okay, that's not why I had the other one pulled up. So, okay. So, is I really need to zoom in further. All right. Total income for the year. All right. We see 42, 45, and 43. So, we have increase and then we have a slight decrease there. Right. Okay. That's for the year. When we look quarterly, when we look quarterly, we see for the 3 months, this will be what July, August, September. They pulled in $1,000 revenue. If we look at the 9 months ended in 2020, they were at 32. Okay, so that means September 2020 we're at 32, right? And at the end, they end up at 42. So that means they pulled in about $1,000 for the quarter. So I expect that same thing to happen for 2021. I believe they're going to bring in about $1,000. Okay, it puts the price closer to 59. The statistics say 64. Again, hard pill to swallow. I'm going to go with the statistics. Okay, we'll play around with 59 here in a second. Interest is really the interest that they're paying on loans. Okay, so 2000 provisions is an interesting one. So about the underwriters, the underwriters and all these different analysts and analysts, what they also do is they look at the potential for loans not to be paid. Okay, and they come up with these numbers. However they come up with, okay, well, 5% loans are not going to be paid back. So what we need to do is we need to make sure that we hold back some cash, right, to cover those losses. Okay, now over the last couple of years, this is very quite a bit. Right, so from 19 from 18 increased 69%, which means they had to hold more money back. And so that's considered an expense for the company because it's money that they have to actually pay. Now, that money doesn't go anywhere, right? They still hold on to it, but they can't use that money to do anything. They have to keep it. And that's the reason why it's booked as an expense, even though it's really not money that they're losing. Like I said, it's just money that they can't, use. All right. Now, where this gets interesting is because that number went way up in 2020, and this has everything to do with COVID, right? Because hey man, when things are looking bad, all of a sudden your formulas and all this kind of stuff to figure out are going to say pull back a lot more cash because we're going to have a lot more losses. And so that's the reason why you see this huge 250% increase in 2020. Now, what's cool is that now everything is kind of, cool. We're not as scared. We're not so much worried about the whole COVID thing, and we're seeing growth and everyone's back to work, right? So not only do we now have less likelihood of loans defaulting, but all that cash that we had stored up back in 2020, well, now we can take some of that cash and we start using it, right? And so currently their provisions are a negative $634, meaning that they have actually made money, right? That goes down as income, okay? That goes down as income. The statistics because of the previous provision expense has this number up, right? Because it's pretty much increased for the last 3 years. I don't see that happening, right? So let's take that down, okay? And that gives us provision of 5. Now, even at 735. What that means is that last quarter, or I should say really for the last 9 months, they've had, like an income of $600 based on the fact that they don't have to use as much provision, okay? Now, we're talking about, again, October, December. October, November, we had the whole variant thing. I don't remember when Delta was around. Maybe that was this summer. I don't know. But the question becomes, are provisions going to just over, like I said, over 3 months? Are provisions going to continue to come down, or are revisions going to tick up? Right? The statistics say, again, based on history, that they're going to have a provision expense, okay? But the provision expense is not going to be anywhere near what it was in 2020. No way, right? No way. So in 3 months, we're saying that the provision expense will have to by 1,300. That's not gonna happen. Not gonna happen at all. Um, so what do we do if we increase provision expense by 600? That brings our provisions now to zero. All right. Um, taxes. Taxes are what taxes does. It does speak to the management of the company, though. We see an increase here. We see a huge decrease in 2020. I'm sure that has everything to do with the tax laws that went into place um, surrounding the whole 2019, 2020 thing. And so I do expect taxes currently are at 591. The statistics put them at 321. I'm going to leave that alone. Um, they're currently at 591. Can that decrease? It can. Will it decrease? I don't know. Will it increase? I don't know. I really don't. So we're just going to go with the statistics there and increase it from the 2020 low of 200, even though, like I said, it's damn near 600 now. So leave it there. Okay, so that gives us a profit now of just make sure I'm doing this right. 26 plus D26. Make sure that's right. Well, so the profit is currently 1468. That's the current profit. And we see that the profit has decreased over the last couple years. Oh, wait. I remember. I had to do for the PE, and we'll talk about that here in a second. Let me make this quick correction. Yeah, because they had ink losses. I had to do a little bit of math to make this thing work. Because as you remember, there cannot be a negative PE. It can't work that way. As long as the stock price is at least a penny, there's no way it can be negative, because even if the company is losing $1 billion a day, if the stock price is a penny, that makes the PE ratio actually like 10,000% or something crazy like that, because the stock price is representative of earnings. But if earnings zero, then so anyway, huge increases. 16% between 2018 and 2019. 183%. That's equivalent of a turnaround. Okay, and we're talking about 2020 versus 2019. This tells me that this is a COVID winner. Do you understand me? 2020 they increased 200%. That's crazy. How did that happen? With all the money that went into banks because of all the free flowing money out there, right? And all the interest they were able to charge on, all sorts of loans and whatnot. So the question now becomes, where do profits go now? Well, currently they're at 2,000. Will that number increase to 25 over just 3 months? I don't know, but I don't expect them to decrease. The only thing that could cause that is that they would have to have some large expense having to do with acquisitions, and it's possible. It's possible that they'll report that, hey, when we acquired this company, we had, some large expense that the company had that we are now taking on. That was part of the deal. And so we have to book it as an expense to our company. And so that can happen. The other scenario, of course, is that when they acquire these companies were already making money, right? And so profits from these companies are now going to be added to their books, and that can profit as well. Again, whether that'll happen, I don't know. But the statistics say that it will, so we're going to leave it there. All right. So it's indicative earnings per share of 2.5. All right, which is higher than what it had over the years. But talking about a company with a growing balance sheet, but also a growing EPS too. Same ratio, by the way, roughly anyway. So 10% increase between 18 and 19. Again, we got a 200% increase between 19 and 20. The statistics give us 2.53 as a predicted EPS. Again, I don't know if it's going to get there. It's currently at 209. Can it get there? For sure. It can definitely get there. And so P of 13. All right. Now, let me explain this P ratio, okay? Because we had losing quarters, or losing years rather, in the past, it's really hard to use historical PE ratios to come up with any sort of future PE ratio, right? It's just, I don't know how you do that, right? So what I did was I simply took an average. Now, the current PE, as I've calculated, is 10.45, which is not far away from the PE ratios I've seen from other websites. I did look at a few. For the purposes of this video, I'm only going to show one other because, as I've explained before, when I'm close, then I know I'm doing something right. And also, too, we're talking about shares that have stayed stable, and it has a lot to do with the PE ratio because they're using the EPS to come up with it. So anyway, in 2018, we see it's negative, which is not possible. 2019, it was negative, which is not possible. In 2020, because of this huge 200% gain, which is basically a turnaround in the company, right, where they went from losing money to profitable, the PE ratio shot up to 10.84. And again, this is based on the highest price that we saw in 2020. Okay, so that gave you a PE ratio of 1584. If I were to choose the lowest price for 2020, that would bring the PE ratio down. Okay, so the higher the price, the higher the PE ratio. Currently, like I said, it's sitting at 10.45. So what I did was to just kind of try to predict this thing, I just used an average. Okay, I just added the PE ratio currently with the 1584, and it's 13 in the middle. Okay, 13 in the middle. And so that gives me a price of $33.24. This is based on the predicted EPS of 0.53. I also used the price. I'm sorry, I've used the earnings per share currently because I thought 33 was just too high. Okay, so EPS right currently of 2.09. Okay, and then I multiply that by the earnings per share of 14. I'm sorry, the PE ratio of 14. Now let's talk about this PE ratio of 14. Okay, so um, I did the same thing with ratios, right? So currently the PE ratio, and let's take a look at that now. Uh, where do I have it? There we go. Okay, so this is Morningstar. All right, again, look at some other websites. Ratio fairly close though. There were a couple that had it at 8, 8 and change anyway. There was one that had it at something. And remember, the reason why differing ratios for stocks is because it's always a predictor based on insight, based on the annual report. Sometimes it's normalized, and what normalized means, you'd have to go Google the definition of Morningstar's PE ratio calculation. Everyone does it different, right? And so that's the reason why mine is different, but it's not far away from Morningstar, so I think that's okay. All right. The other thing I want to talk about too is the price to book. Okay, so again, remember, my price to book does not include intangibles or goodwill and things of that nature, so it's going to be different than what you see here on Morningstar. But with that being said, so their PE ratio of Morningstar is 7.97. Okay, mine is 10.45. All right, so what I did was I just looked at what the percentage difference was between the 7.97 and my 10.45 and multiplied it, multiplied it by what the rest of the sector, or I should say their competitors, are doing, right? And I thought this was very telling too. So let's look through this. Let me show you quickly what the companies are. So Regis Financial, and I looked at this too in my last valuation. Same companies. Truist Financial, PNC, which is my new business bank, by the way. Wells Fargo are their direct competitors. The reason why is because Regis Financial is what's considered a neighborhood bank, right? They are not involved with investing, financial. If you want to open a brokerage account, all right, they don't sell funds and things of that nature. They're strictly like, hey, opens up a channel loan, call us. And that's pretty much it. I think they're doing some great things with just seeing these other assets that also include loan portfolios and things like that to just really increase their profits and kind of broaden their suite of services as far as loans go. So anyway, so that's the companies that we're looking at, okay? And so this is just very straightforward. What I want you to look at are the comparisons between Regis Financial here highlighted versus the rest of their competitors. So right now, price to book, okay, 1.23 for Regis Financial, 1.25 for Truist, 1.51 for PNC, 1.4 for Wells Fargo. And I think we've discussed this before. Wells Fargo, because of some of the problems that they've had and trouble that they've gotten in, has not been a popular stock, even though the business is doing fairly well. I don't follow the company very closely. But either way, the point is that the price to book for Regions is about what their competitors are at. It's not. So what that means to me is that the price to book I calculated, it again fairly values this based on what the rest of the market is doing, or the rest of the industry rather, right? I mean, if their competitors have about the same book valuation, then it means that Regions Financial's book valuation is about right. It's fair, right? But the PE is not, and that's interesting. And a lot of this, I think, has to do with popularity. And that's one of the more romantic um, aspects to investing is that part of investing is, we've all heard buy low, sell high, but what that really means from this romantic perspective is what you want to do is you want to find, and I'm going to use a girl in this instance because whatever, right? So you want to find that girl that you look at, and she may not be the most popular, right? May not be priest, but you can see her potential, right? You can see that um, she has a great personality. You see that, life is in a good direction, and you can show that, man, if this and this happens, right, or she does this, then she's gonna be a knockout, right? And that's part of investing too. And so when you look at a PE ratio, that's literally what it's telling you, right? It's telling you how, I don't want to use the word cheap, right? But it's showing you like how how much potential is there for this particular company, okay? But as I say, the opposite can also be true. If you're in a school and you see the girl and you're like, wow, like, you know, she's really pretty. She's really pretty. She has a great attitude, but for some reason, no one likes this girl. It's like, what the hell is going on? And so that's also what a PE ratio can tell you too, because guess what? A lot of times you meet the person, get to know them, and you say, "Oh, okay, now I get it. This is why no one likes you, right?" So yeah, you may be pretty, you may have seem to have a great personality, but you got these other issues that nobody wants to deal with, and that's why your PE ratio is lower than everyone else's. So it can mean one or two things. Sometimes it can mean both. You know what I mean? And that's the reason why it's important to do these fundamental analyses on these companies to really understand what they're about, what they have, and where they're going. So um, just compare. 797 for Regions, 1147 for Truist, 1113 for PNC, and even 11 for Wells Fargo, which doesn't seem to be, in anyone's favor currently, really, right? The other thing that's important to note is that when you see this investment style down here, right, a lot of this has to do with typically where you will find these particular companies in a fund, right? When you purchase mutual funds. But in reality, what this really it means is just how big or how small the companies are. So if you look at Wells Fargo, 1.9 billion, okay, that's crazy. PNC 84, meaning they're less than half of Wells Fargo, and then you have Truist at 78, and then you have National over here at 20. So they are the smallest bank in their um, in their group of competitors, right? But when you think about the fact that, again, we only invest in the largest companies in America, this is still a huge company. 20 billion is nothing to sneeze at all. But compared to their competitors, they're tiny. They are tiny. And so maybe that has something to do with their P ratio as well. Regions Financial has never really been popular, but it doesn't mean that they can't become popular. And I think they're doing some good things, like I said, as far as the companies that they're bringing on. Let's take a look now at insider trading. Okay. Now, I did not, I did not, I don't have this queued up, but I do know that Regions Financial, about 75% of the total stock is held by insiders. And so, what are insiders? Insiders are financial institutions. Um, well, I'm sorry. I apologize. I apologize. Not insiders, institutional investors. That's what I meant. Sorry. Roughly 75% of Regions stocks are held by institutions. Okay, institutions are banks, they're mutual funds, there are other financial companies like Fidelity, things of that nature, that purchase these shares a lot of times on behalf of their clients, or sometimes they'll purchase these shares to create a mutual fund that then their clients can give them money for. Okay. So the reason why this is important, though, is because a lot of the times what they call institutional investors is smart money. Okay, that's just like a colloquial term for institutional investors is smart money. And so the question is, what are the institutional investors doing? Are they buying more of this company, or are they selling more of this company? Right? And that's what we're looking at right here. This is direct from the NASDAQ, so I trust it. Let me blow this thing up. And okay, there we go. All right. So, oh wow, yeah, the internet is just not great right now. There we go. There it is. That's where I saw it. So yeah, institutional ownership, 75%. So that means 25% is owned by retail investors like myself, and also um, the employees, the CEO, all that kind of stuff, right? So 25% of the shares are owned by those. Also, too, when you talk about institutional investors and smart money, this also has a lot to do with price movement too, because if you can imagine, 25% of if 25% of the owners of the company just sold the company, it was like we're done, right? It's definitely going to move the price. It's definitely going to move the price. But if 75% say no, we're not selling, then when you think about it in those terms, price doesn't move around that much. The institutional investors are really the ones that move the stock price forward, or better yet, institutional investors can really impact the stock price moving up and down. So again, 75%. I don't know what that is compared with their other competitors. And so this is what we have, and this is as of, I believe, September 2021. I may be wrong in that assertion. Maybe this is more recent, but this is where we're at. Okay, so 364 increased their positions, which means they already own the stock, but they purchased more of it. Okay, 323 decreased their positions. And I think what's also interesting here is the number of shares. Okay, so that means 323 people decreased their positions, but they did sell more shares than 364 people bought. So what that means is that the people who do own it bought less, and the people who own it who sold more. Um, a lot of times that has to do with profit taking, right? When the stock price goes high, people sell shares and they take profit. Okay. Sometimes less shares get purchased. Again, when the stock price is high, sometimes less shares get purchased because I'm not so sure about this company. Um, that's just what happens. All right, so let's take a look at this. I thought this was interesting. So new positions. So these are institutional investors that you know started owning this company versus completely got out of. 69 new persons purchased this company, but 67 completely sold all of their shares. Right. So again, it means we have more people that's buying into this thing than selling out. But again, looking at the number of shares, there's more shares sold than purchased, and so just a definition of why a stock price moves up or down. It's like 2187, 2489, roughly. Actually, I think it made it to close to 24 and some change for sure. Um, and yeah, that's why the stock price has come down. Shares being sold. But again, like I said before, they do have the right constantly buying more shares and initiating new positions. I think is a good thing. And so you can see the date here, 2021. Even yeah, so this is as of 9:30, the last earnings call basically. All right, let's go back. So again, that's how I got the 11 PE ratio, because the idea is if Regions Financial catches up with their competitors, right? If their PE ratio catches up with their competitors, that's going to put them at a PE ratio of 11. The other thing I wanted to do here, because let's see, let's D, yeah. The other thing I want to do here is because I played around with these numbers, I want to, instead of using statistics to give me my profit, I'm going to see exactly what I come up with myself for a profit. Let's see. Oh my goodness. So, wow. Yeah, so 2020 profit was 66. We're currently at 49. And I said that I was gonna do this. So let's do that. Let's put 59, which we know for sure they can definitely pull in for the quarter. And that gives us a profit still of 34. And we're currently at 2,000. And that's even after we um, decrease the provision. So if they increase their, which I don't know why they would, honestly. Um, I don't know why they would, but maybe, that still gives us a profit of 34, and then that will give us earnings per share. And going back to the conversation about the shares, I'm going to use the current shares. No, actually, I remember looking at the shares on what was that, like Yahoo or something. I think they had the shares at 962, and my prediction is 963. So let's go ahead and do that. Um, that gives us an EPS of 3.58, which is just crazy. Um, it gives us a price of $47. Let's say that sentiment doesn't change, right? Regions Financial just keeps being boring old Regions Financial. That still gives us a price of 28.64, which I can actually okay with, right? Because 33, 32, way up there. 47 is definitely a crazy number. But 2864, I can be okay with that, right? So, um, oh, wait. No. That's not going to work. Because 8 is what Morningstar has. So what I would have to do actually is I would have to use my current PE ratio of 10. That still gives me 37. I mean, either way, you know, I can I can play around with this thing, and I mean, again, like I say, I wasn't expecting this at all. Was not expecting this at all. I thought that I was gonna, you know, do this and figure out that, hey man, this is probably not a great position to be in. Maybe we ought to get out. Or, you know, look at this thing and say, oh, yeah, it's fairly valued, not bad. But, you know, based on the earnings, based on profit potential, especially, like I said, the fact that they're adding these companies that's going to do nothing but improve their loan assets. Um, and increased last 3 years. You know, it's not a fluke. They have consistent improved their balance sheet, no doubt. So look at a company that is definitely under the high for 2024, um, even at a decreasing PE ratio. I have the company at 28, and again, assuming that let me make sure I'm doing this right because this is hard to believe. The profit. Oh, okay. Let's do this because I want to bring this down as much as I can. Let's assume that the taxes actually increase. Okay, so it's at 591 now. Let's say it goes to 600. That still gives us a profit of 31 and EPS of 3.29. That still undervalues the company by a little bit. So yeah, I don't know. I mean, again, historically, they have decreased their interest expense, right? And it's currently at 2894. It was at 4,000 last year, so that's definitely a decrease. It was at 7,000 in 2019. So increasing it to 21, yeah, it can happen, right? It could definitely happen. But even if I move it to 29, and again, the provision, why increase their provision, right? Why now with the economy at low unemployment and again, from my understanding, the COVID thing's kind of waning. I mean, it's definitely picked up as far as restrictions and stuff like that. There's been some flight issues or whatnot. I can't imagine they're going. Now, here's the other thing. What if they decrease their provisions, right? And then we're like, you know what? We kind of made a mistake by, too much, and we need to raise it. Even if they did do that, it's still not going to be this 600. It's not, you know. And I'm trying hard. I'm trying hard to take money out of their pocket, but um, it's tough. Let's see. Profit goes to 20 based on provisions of -3. Make sure I did that right. 24 minus 24. Yeah, I see. Exactly. It's because I had a 0 there. So I have to actually use a negative sign. Yeah, that's still. Still gives me EPS of 2.8, but um, that did drop the price quite a bit for sure. And so 22.42. I mean, yeah, there's so much going on here. Um, Wait a minute. This goes to zero. Four. Oh yeah, yeah. Okay. That's right. Yeah. So, provision is going to have a lot to do with this. Um, what did I change though? Something happened. Brought it way down. Because now we're looking at the price being overvalued. So we're saying if tax stays the same, if provision goes up by 600, if it stays at 600, that gives us so at this point everything is hinging on the provision and tax. Um, I don't know. You know, I'm not going to because why the tax? Why did it take such a jump um, now? You know, um, I don't know. The tax thing. I'm gonna leave alone. I'll leave it there. I'll just say that whatever the tax is currently will be the tax as reported, right? So it looks like the provisions is going to be what really makes the big difference here. And again, I can't imagine the provisions moving much um, at all. I still think it's going to be a positive for the company this last quarter. It'll be a positive for the year. Um, and that undervalues the stock quite a bit. 491 is what I have it at. Um, 30 again is what I have the company valued at based on if Regions Financial matches their competitors' PE ratio, right? If they match their competitors' PE ratio, then we can see this thing go to 30. Period. Period. Right now, they're at 8. Everyone else is at 11. That's simple. So if their PE goes to 11, then we can see a price at $30. And again, this is talking about the highest price for year 2022. All right. So I'm saying that anything above a 30, eh, there's something going on, right? There's something going on. Unless, something happens with this last earnings or, next couple quarters that just blows everyone away. I don't see anything going above 30. Currently, the price, I think conservatively, right? Conservatively should be about 24, $25. And for a fact it has gone to 24.89 just a couple months ago. And that's where the price should be. So currently the price is undervalued. Okay, we're talking about from a book perspective, and we're talking about from an earnings perspective. Okay, I'm going to put my stamp on it. 24.91 based on earnings, 24.89 based on the books. And again, you see me play around with this thing. The provisions is going to make all the difference. Um, if the provisions tick up a little bit, right? Um, and and again, we're talking about the PE ratio not moving at all. Have the thing at 33. I have it at 33. So we'll see. We're definitely going to look to add shares at this 21 price. I did see some activity in the options at around 18. I like that idea. And I think those were dated somewhere around first couple weeks of February. So I think that's where we'll look to add some shares if we can get it. If we can't add shares, we'll keep the premium in our pocket. That's it. Regions Financial. Oh wait, I did want to take a look at this real quick because again, I did look, try to find something on this Sabal Capital Partners. I couldn't find anything. I did look at Glassdoor to see what some of the employees had to say. Again, we're not going to get any of those employees for Regions Financial. They're going to stay with Sabal. But I did look at their Fitch rating, and Fitch is basically like an Experian or TransUnion or whatever. They do credit ratings for different sort of banks and financial institutions. Because Sabal does not only multifamily stuff, but also commercial property loans and all this kind of stuff. They have two different ratings. And so this is where they are at currently. They have a C2, okay, and then a CSS3. And I will tell you that the lower the number, the better the rating, okay? So, and this is as of November 2021. So let's take a quick look at that definition. So remember, 2 is higher than 3. So 2 means that these servicers demonstrate a high performance and overall servicing ability. Characteristics may include the following, blah, 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 blah. All right. That means that this is just one notch below the best, right? Because it's going to be the best. And so number 2 is just a notch below that. Level 3, which is another rating, says these servicers demonstrate proficiency, okay, in overall servicing ability. Characteristics may include the following. And so when we talk about servicing ability, we're talking about servicing the loans. That means that not only are they able to, get these loans processed and in, but they're also good at, touching base with their clients. When a client misses a payment, how quickly are they getting on the phone and getting emails out and saying, hey, what's going on? Why haven't you made your payment? Do we need to modify the loan? Do we need to maybe put off your payments for a couple months? What do we need to do to make this happen and to make this work? And that's really important when you talk about loan processing. Also, too, just to mention, Sabal has what I guess is a decent software that they use for processing loans and selling loans and whatnot that Regions Financial is now going to own. And so I imagine that they're going to maybe, I don't know, implement that particular software for all of their other loan service agreements, meaning that, maybe they get things done more efficient, less expenses. Maybe they increase those loan sales. So that's it about Sabal. Really excited about that. We won't know what Sabal is going to add to the bottom line or the balance sheet until we have a an annual report. I do want to show this though. I did a simple, technical analysis. I typically don't with investments because investments are something that you hold for a fairly long time. And technical analysis is typically done for something that you want to know right now, right? But I did want to pull this up because I do think it's interesting. Okay, so there's something in technical analysis called a death cross, all right? And what that means is that the 50-day moving average moves below the 200-day moving average. And that simply means that the current average price is worse than the historical average price, and it's seen as a bad thing, period. And so we see that death cross here back in September um, 2021. Um, and just to kind of give you a quick um, overview here. So the thin purple line here that you see highlighted, that is the 50-day moving average. The thin red line down here is the 200-day moving average. And the thin blue line with the ball on the end of it, that is Regions Financial. Okay, and so we can see that Regions Financial is currently under their 50-day, but they're above their 200-day. And so that's typically a good thing, right? It means that the price hasn't moved down too much. Now, it did fall below its 200-day just recently. But looking back just over the last year, we can see that the price has really kind of just bounced off of this 200-day moving average, right? It's definitely dipped below it more than a few times, especially during this death cross here, where it dipped way below. And the reason why the death cross is important is because it is such a well-known technical indicator. The idea is that when it happens, all of the techies, right, that know about this indicator are going to sell based on that simple indicator, right? And so it's just market psychology, right? It's like if you think everyone's going to sell, then you probably ought to sell too, right? And that's the reason why I've seen it's such a bad thing. But again, like I said, just over the past year, it's really just kind of bounced off that 200-day. It's pretty much stayed above it, and that's kind of where it is now. And we do see that it has also, of course, been above the 50-day. And this is where it got all the way up to almost $25 here. Again, just recently. The other thing that I did was I compared the price action of these other companies in their peers. So we got Truist, we got Wells Fargo, and we got PNC. PNC is the black, Wells Fargo is the green, TFC is the purple. I think a better color, I think. But anyway, so currently, Wells Fargo is the only company that is above or has performed better than Regions Financial. Now, that is not the case for the companies in our basket of stocks, as we have seen. But compared to their closest competitors, Regions Financial has basically outperformed them every step of the way, except for basically Wells Fargo, which I've said before. I mean, it's a huge company that's been involved in a lot of stuff over the last couple of years, and there's been a lot of talk about it. And as they say, all news is good news. And so, you have the people that, when the bad news comes, stock price drops, they get excited because they figure it was a cheap stock, and then they buy the stock and it moves the price way up. That kind of stuff happens. But the other competitors, just they haven't really performed as well. TFC has kind of outperformed a little bit every so often, but for the most part, they haven't. And then we see this black line down here that seems to always be at the bottom. PNC, they've way outperformed them. So, technically, you don't like seeing a death cross. You know what I mean? But technically, I think the stock is in good shape. The other thing I looked at was RSI, which is a relative strength indicator, and this has to do with volume, right? This has to do with how many shares are being traded. Okay, and so we see here these red and green lines. Green means that And how tall the lines are tell you how much volume, right? So the difference between 500,000 shares being traded in a day versus a million shares being traded in a day. So when you see these really tall lines, that means that a lot of shares have been traded. And so, red is sold, green is buy, right? Okay. Long term, which doesn't mean a whole lot, honestly. The RSI is right around 50. Okay. And so when you get to an 80, that means that people have purchased too many shares. I mean, they bought a bunch of shares with a lot of volume. And typically, when you get to that point, a lot of people will say, it's time to sell, right? Because you're not going to see an RSI above 80 for very long. It can happen. It does happen. But again, that's just one of those technical indicators that they're like, when it gets to 80, you sell, right? And so we see that it has gotten to 80, right? Once or twice over the year, okay? And that coincides with, that $24, $25 price. And currently it's at 46, okay? And the same goes for this bottom line here, which is 20. 20 typically is a technical indicator that, too many people have sold this thing, right? And you're not going to see an RSI below 20 for very long, so it's time to buy, okay? Again, it's definitely happens, definitely can happen. You can have an RSI below 20 for quite some time when it's a company that just people just don't like, or they just think that it's going to go out of business or something. I mean, it happens, right? For Regions Financial, though, just kind of looking back over the year, we see that the RSI has really been bouncing off of this roughly 30 RSI. I don't know if it's gone down to 20 in the recent past. I'm sure it has at some point, but just recently though, it's just been bouncing off this 30. And like I said, currently we're at 46. If we put the line on 46, you see kind of what that means in the past, and it's been under 46 before. Not a lot though, right? RSI has typically been above that 46 range, and so again, technically, what that means to me is that right now the price is at its lower range, okay, and the really reason why I really wanted to show this technical analysis is because, watching this thing day in and day out, what I've noticed is that the price hovers right around 22. It did drop down to 19 a couple days ago when the rest of the market dropped, but as soon as the market came back, Regions Financial went right back up to that 22, and that's where it is now. It's 2187. Minus like 22. That tells me that 22 is the actual fair value of the stock as far as the market is concerned, right? That doesn't mean that the market is right or wrong. It just means that that's what the market says the company is worth, roughly 22 bucks. And that's what analysis is about, right? Analysis is saying, hey, I think the market is wrong. Whether or not the market has overpriced something or underpriced, that's the point. And so with this particular company, I'm saying for sure that the market has underpriced it. It's worth more than 22, period. Again, I'm putting it about 24, 25. 30 is the top of the range. It can make it to 33, possibly. But I'm saying 30 is pretty much the top. So that's it. Regions Financial, December 2021.